Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London UK feed wheat. I'll start with Paris milling wheat. The recent April to date base pattern is not so clear here as in Kansas City or even Minneapolis, but it's still there. I'll discuss this shortly, but first I'll outline the recent market. Okay, so peak in mid-May was not the key to the recent move lower. No. Instead, it was the combined big key reversal down and bearish engulfing pattern that finally put pay to the moves higher in this market a week after the mid-May peak. I suppose the most surprising thing, actually I suppose it isn't that surprising, but what on the face of it seems surprising is how a lesser recent 61.8% Fibonacci line at 389.5 proved to be the low for that week. 2 weeks ago, that support gave way, but only saw the market move down to what appears to be a stronger combination of supports. They are the rising short-medium moving average, currently 383.5, and the 50% Fibonacci line for the March to May move at 374 3/4. This is just the tip of the support, as further below we have the 50% Fibonacci line for the whole of the 22 action at 348 even, and then the rising medium moving average, currently 350 1/4. Plus the lows of March between 311 3/4 and 315 3/4. I've said this earlier, and I quote, even down there, I should say, we are still in pullback territory, in theory at least. It's only when we start going below the rising long moving average, currently 312.5, that we must start to consider the bullish incentive expired and other force may be taking its place. Personally, if we see prices back within the wide congestion created by the January action of 258.5 to 288.5, well then, maybe I would really start to look at the downside again. Otherwise, keep a wary eye lower. End of quote. Caution now. What I have seen this week in the other grain markets may well lead to a readjustment of that scenario. You see, and here I will deal with what has been building up since mid-April. So we may have here a possible head and shoulders pattern. Now, head and shoulders patterns are typically seen as bearish reversal patterns, such as the one that is building up here, but not always. Sometimes they are bullish continuation patterns. I thought I ought to let you know just in case. This one here is not a perfect example of head and shoulders pattern. The left shoulder is weak and the right shoulder has not formed fully or formed properly. But we have a combined key reversal down and bearish engulfing pattern here today, which may assist in that. I've been sufficiently prompted by the other grain markets. I've decided to place two prospective targets here on the downside. Target X is the primary target, is in the 336 area. And a secondary target, X1, is in the 299 area. A secondary target is the harder to get target. I must point out that these are purely prospective this time, as the neckline has not been convincingly broken as yet. London UK feed wheat. I made the point each week here of saying that there was a lot less to go on here compared to some of the other grain markets. However, even with the limited information we have here, the April to date pattern is still visible, if disjointed. Just to recap some of the recent actions. The peak in late March was the start of the last major completed pattern we had here. We had a late March to late April ascending wedge pattern. This pattern was not the best ascending wedge pattern that I've ever seen. Even now it looks a bit, ropey. But it is a true pattern, and it reached out not only to its primary target, but also to the harder to achieve secondary target. What became very interesting was what the market did immediately after reaching that secondary target. So let me describe the situation. Okay, so with all this bullish energy spent, the market suddenly, a shade bearish, coming ever so close to making it into a weekly key reversal down. The conditions were set by close of business 4 weeks ago, and all it needed to happen was a close 4 Fridays ago at or under the 335 even level. That was all that was needed. Well, we closed at 336.5, a shade away from fully bearish, but enough to prove two things. Firstly, that there is some serious technical analysis action going on in this market. And secondly, to give this market a shadow of potentially lower prices in the following week. True to form, as prices dropped every day until last week, when it was rejected back upwards by the lesser Fibonacci lines at 287.55 and 285.70, as well as the 50% Fibonacci line for 2022 at 283.70, with the rising medium moving average currently 289.25 backing up as further support. The questions here are the same as in the other grains. Firstly, is this a pullback or the beginning of a bearish phase? And secondly, how far will the drop fall? Well, the answer to the first question is yes, it is still a pullback, but I will keep a wary eye on it. The answer to the second question last week and in recent weeks was it depends. Sorry for being obtuse, but it does depend. Up until last week and this, all we've seen is a pullback that has punched down, halted at some significant supports. There are other supports below, such as the congestion between 262.5 and 265.5, then 250.5, and then a band 239.25 up to 245.15, which has the rising long moving average, currently 250.20, moving just above it now. The long moving average is ultra important, and I would have said until this week that you could only say the bullish incentive has been extinguished and a bearish incentive has replaced it if that one was broken. However, we have a potential new pattern in the offing, one that has been evident in all the other grain contracts to a greater or lesser degree. It is to look at the March to date action as a very big head and shoulders pattern. Now, this is by no means a good head and shoulders pattern here. For starters, the left shoulder is small and the right shoulder, well, could use some bulking up. However, it is there, and despite it not being broken, I feel obliged to place some prospective targets for this pattern below, in the case of it being a bearish topping action. Hence, we have a primary target X in the 252.25 area, and a secondary target X1 in the secondary harder to get target X1 in the 217 area. I must stress that these are still prospective targets at this time. Now, there is one other significant, let's call it dynamic support, that needs consideration to all these, and that is the medium moving average, which is currently 289.25. I've said before many times that if prices should fall to whatever level the medium moving average rises to, then it would be worth reassessing the whole situation. Well, this reassessment should start from now, as I have the suspicion that the medium moving average may well be support, or it may well be the trigger for a major move lower. Watch carefully as the neckline of the prospective head and shoulders pattern is only a little lower at 287 even, though I may finesse that neckline further. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.